Imagine waking up in a world where owning something isn't proved by a stack of paperwork, a registry office, or a bank's internal database, but by a record on a blockchain that anyone can verify. Not a meme coin, not a speculative token, but the actual proof of ownership for real valuable things. Government bonds, land titles, infrastructure stakes, even commodities. That idea used to sound like sci-fi to most people outside crypto, but the reason it's being discussed seriously now is that it's starting to move from theory into conversations happening behind closed doors. Changpeng Zhao, better known as CZ, helped build Binance into the biggest crypto exchange on Earth. And even though he stepped down as CEO, he still has enormous influence and deep relationships across regulators, institutions, and crypto builders. When CZ says he's speaking with more than a dozen governments about blockchain adoption, and specifically about tokenizing national assets, that matters because it signals a shift in how governments are approaching the technology. For years, many governments treated crypto as a risky sideshow, a space for speculation, scams, and volatility. Now, at least some of them are looking at the underlying rails, blockchains, as a way to modernize how ownership and finance work. To understand why this is such a big deal, you have to get crystal clear on what tokenizing government assets actually means. Tokenization is the process of taking a real-world asset and representing it as a digital token on a blockchain. The token isn't just a random digital coupon. In a properly designed system, the token becomes a legally recognized claim to the asset or to the cash flows that asset generates. So instead of your ownership being recorded in a slow, siloed database, it's recorded on a shared ledger that can be transferred more easily, verified instantly, and, depending on the design, made accessible to a wider range of investors. Now think about what kinds of assets governments control. Governments issue bonds and treasury bills to fund themselves. They manage land registries. They commission and own infrastructure like roads, airports, power plants, and ports. Some control commodities or oversee national resource rights. If those assets are tokenized, you can theoretically create a system where ownership, transfer, settlement, and auditability become faster and more transparent, with fewer intermediaries. In traditional finance, buying and settling many assets can take days, involve multiple middlemen, and rely on reconciliation between databases that don't perfectly match. That's one of the hidden taxes of the current system: time, friction, and cost. A useful way to frame it is this: Bitcoin digitized value transfer in a way that doesn't require trust in a central party. Tokenization takes the next step by digitizing ownership itself, who owns what, and what rights come with that ownership. If money is the bloodstream of an economy, then ownership records are the bones and joints. When those records are outdated, fragmented, and slow, everything moves less efficiently. Tokenization promises a world where those structures become more fluid and more programmable. So why would governments, often slow-moving and cautious, be interested now? One driver is pure efficiency. Governments and financial institutions spend huge amounts of money running settlement systems, maintaining records, auditing transactions, and dealing with paperwork-heavy processes that are vulnerable to delays and errors. Blockchain-based settlement can, at least in theory, reduce settlement times from days to minutes, lower administrative overhead, and cut out layers of reconciliation. Even if a government doesn't care about crypto culture, it cares about cutting costs, increasing tax efficiency, and improving infrastructure reliability. Another major driver is transparency and anti-corruption. In many countries, land ownership disputes, fraudulent title transfers, and opaque asset sales are serious problems. A well-designed tokenized registry can make it harder to quietly alter records because changes are recorded immutably and can be audited. That doesn't magically eliminate corruption. Bad actors can still corrupt the inputs, but it raises the difficulty of tampering with records after the fact and makes auditing easier. For developing nations especially, trust and transparency aren't just ideals, they affect investment, economic stability, and public confidence. There's also the pull of global liquidity. Many national assets are effectively trapped inside domestic systems. Investors face barriers like local custody rules, slow settlement, complex paperwork, and limited market access. Tokenized assets can be structured so that a much wider pool of investors can access them, potentially even in smaller denominations. Instead of a government bond market being dominated by a handful of large institutions, you can imagine a scenario where ownership can be fractionally distributed more broadly, while still meeting compliance requirements. That broader access can increase liquidity, lower borrowing costs, and expand the investor base. Whether governments choose to allow that level of openness is another question, but tokenization creates the option. Then there's competitive pressure. Countries compete for capital, for talent, and for financial relevance. If one nation successfully builds tokenized bond issuance or a blockchain-based land registry that improves investor confidence and reduces friction, neighboring countries and rivals start paying attention. Governments don't want to be the last ones modernizing their financial infrastructure. This is similar to how digital payments spread. Once one region upgrades and benefits, staying on older systems becomes a disadvantage. This is also why someone like CZ becomes involved. Governments don't just need software, they need someone who understands the messy reality of deploying crypto infrastructure in the real world: regulations, compliance, custody, identity, capital controls, and the political optics of working with public blockchains. CZ's unusual value is that he has operated at the intersection of global crypto adoption and regulatory negotiation. He's seen what breaks, what scales, and what causes political blowback. When he says governments are asking for guidance, the implication is that they aren't simply exploring crypto as a trend, they're exploring it as national infrastructure. Of course, tokenization doesn't mean governments will put everything on chain overnight. The first wave would almost certainly focus on assets that already have a clear digital footprint and standardized issuance processes. Government bonds and treasury bills are near the top of that list because they're already formal financial instruments with defined cash flows and mature markets. Tokenization could make issuance, settlement, and secondary trading more efficient. Another early candidate is land and property registries, because the upside, reducing disputes and fraud, is huge, and the asset class is foundational to economic development. Infrastructure finance is also a strong contender. Governments often want private capital to fund projects, and tokenizing infrastructure exposure can create new ways to raise money, distribute returns, and track ownership. Commodities, carbon credits, and resource-related instruments are also likely early options. Carbon markets already rely on tracking, verification, and legitimacy. Tokenization can improve traceability and reduce double counting. Again, not automatically, but by creating better audit trails and standardized representations. Commodities and trade finance also suffer from paperwork and settlement friction, and they operate across borders where shared ledgers can reduce disputes. If this trend accelerates, the implications for crypto are massive, not because it pumps a random token, but because it changes what blockchains are for in the eyes of the world. Crypto stops being viewed primarily as a speculative asset class and starts being viewed as a settlement layer and record-keeping infrastructure. When that shift happens, legitimacy follows. Institutional adoption becomes more than buying Bitcoin on a balance sheet. It becomes building systems on top of blockchain rails. That's when blockchain stops being a niche topic and becomes part of the plumbing of finance. From an investor perspective, tokenization at government scale implies that the total value represented on-chain could expand dramatically. Traditional assets, bonds, real estate, infrastructure, are measured in tens and hundreds of trillions of dollars globally. Even a small percentage migrating to blockchain-based representations is enormous compared to today's crypto market size. It also blurs the line between traditional finance and decentralized finance. If tokenized government bonds exist as blockchain-native assets, they can potentially be used as collateral, integrated into lending markets, automated into treasury management strategies, and traded 24/7 in ways today's systems can't easily support. But none of this comes without serious risks and trade-offs. The biggest tension is control versus decentralization. Governments typically want oversight, reversibility in extreme cases, and enforcement tools. Purely decentralized public chains limit those powers by design. So many governments may favor permissioned blockchains, networks where validators are approved entities and access is restricted. That can deliver efficiency and auditability without giving up control, but it also changes the ethos of what many crypto supporters want. It becomes blockchain as a database upgrade, not blockchain as a decentralization revolution. Privacy is another challenge. Putting ownership records on a public chain can raise concerns about surveillance and confidentiality. The solution might involve privacy-preserving techniques, selective disclosure, or hybrid systems where sensitive data is kept off-chain while proofs or hashes are on-chain. But designing those systems safely is hard, and mistakes can have real consequences. Scalability and reliability are also non-negotiable. Governments cannot run critical national asset infrastructure on systems that frequently congest, spike in fees, or break under load. That pushes them toward networks with strong performance guarantees, mature tooling, and robust security assumptions. It also means tokenization will likely roll out slowly, with pilots, sandboxes, and limited-scope implementations before scaling up. Finally, there's political resistance. Modernizing a system threatens the people and institutions benefiting from the old one. Middlemen, bureaucratic structures, and entrenched interests don't disappear quietly. Even if the tech is sound, adoption can be blocked by politics, inertia, or fear, especially when the word crypto carries reputational baggage in some circles. When you put all of that together, the most important takeaway is that the conversation itself marks a turning point. A few years ago, governments largely treated blockchain as something to regulate from the outside. Now, some are considering using it as a foundation for how assets are issued, tracked, and transferred. If CZ truly is in discussions with over a dozen governments about tokenizing national assets, it suggests the next phase of adoption won't be driven by retail traders chasing hype. It will be driven by states and institutions upgrading infrastructure. And that's why this story matters. Not because it guarantees a straight line upward for prices, and not because it means every country will embrace public blockchains. It matters because it signals that blockchain is being reframed as a tool of state-level finance and administration. Whether this leads to a more open financial system or a more controlled one depends on implementation choices, public versus permissioned networks, transparent versus privacy-preserving designs, open access versus gated participation. If you're watching the future of money unfold, this is the kind of shift that changes the entire map. The question is no longer, will governments ever take blockchain seriously? The question becomes, what kind of blockchain world will governments build, and who benefits from it?